Welcome to Common Sense Investing. My name is Cameron, and another live stream, another weekly live stream talking about microcap stocks because that's what I love to do. And maybe I'm crazy for doing this every week, but I keep plugging away. I think I'm pretty consistent. I had about 50 public live streams last year, so I only missed 2 weeks out of a 52-week year. That's not bad for a guy on YouTube that has a small channel like mine, at least in my opinion. As always, thank you for joining. Really appreciate it. You could be anywhere and you're here with me talking about microcap stocks. Maybe that just says we all have the same problem, but I absolutely love it. As always, I have a presentation for you today. I got about 35 slides to go through. I'm not talking about a lot of stocks. So as always, during my presentation, if there's stocks you want to talk about or anything else you want to talk about in the microcap stock space, let me know in the comments and I will eventually get to you at the end of my presentation. There's not a lot of stocks to talk about today. Hello, and thank you for everybody that's joining. Really appreciate it. People are starting to flood in here right now. It's gone from about 4 people to 16 in about 30 seconds. I love it. So if there's any stocks you want to talk about today, let me know, because I'm not specifically talking about any stocks today. It's a new year. This is my first live stream of 2026 publicly anyway, and it's time to talk. There's just not a lot happening right now. It's time to talk about strategy, what's different in 2026, start back at the basics. I think that's what a lot of people are doing right now, at least on social media. I'm seeing a lot of posts about the year in review, thoughts, what I've learned, how my performance did, how my portfolio was, what I did right, what I did wrong. Those are all excellent things to do. I really suggest that people go through that exercise and do that for yourself. Set new goals for 2026. Because why not? Right now, there's not a lot of news in microcap stocks. It's the first day of the first week of 2026. That's the full week of trading anyway. I know the markets were open, last week for a day or two there in January, but really this is the first full week. We've had a nice green day, but our inbox isn't filled with news yet. So there's not a lot to talk about. And that's okay, because there's so much other things to discuss in microcap stocks. Now, recently, and one of the things that I love to do is plug some other channels, right? I think we work better as a community, and especially for new investors that follow my platform or watch what I do. I want to make sure I point everybody in the right direction of some fantastic microcap investors. So I do spend a lot of time talking about small cap discoveries, which focuses on Canadian microcap stocks specifically. And then I spend a lot of time pitching Ian Castle, of course, though I don't know why. How come I have never seen this before? I think I have 4,000, 4,200 subscribers or followers on X, Twitter, whatever you want to call it, right? I thought this was pretty good for microcap stocks. Somehow Ian has 282,000 followers. I don't believe it. I do not think there is 282,000 microcap investors in the world. So I don't know if Ian Castle doubles as like a political satire channel or something like that. He's got some kind of side hustle going on here to attract so many followers. But I mean, absolutely, congratulations. That's a huge channel for Ian Castle. So I don't know why I'm pitching him. He doesn't really need it. But I do in a lot of these live streams, like educating newer investors and having communications with experienced investors around some of these opinions from guys like Small Cap Discoveries, Paul Andriola, and Microcap Club, Ian Castle. Right here, just talking about this post from Ian Castle. They're such great conversation starters, right? Like where Ian says that investors hate to see other investors make money in things they don't own or believe in. When you generally don't care, it can be a superpower. You don't get distracted holding in that negative energy, and it frees you up to focus on what you're doing, expanding in your own circle of competence. I absolutely agree with this, at least partially. I don't know. Thank you for all the people that have been following me since my first channel. I did have a first YouTube channel that got canceled because I was exposing a lot of pump and dumps and a lot of meme stocks and a lot of other terrible investments. And people don't like when you talk about all these pump and dumps. There's a lot of money to be made in these things, especially in microcap stocks. And my channel ended up getting canceled. So while I agree, like I gave up a long time ago, criticizing like Bitcoin and crypto, right? Have at her. I don't really understand it, but you have to admit, like people have made a shit pile in money in Bitcoin. And if you can go back 10 years and invest in just one thing, it would probably be Bitcoin because of the significant gains. So I'm done having a heart attack about that type of stuff, but I do have to disagree here with Ian Castle is that I still, you know, a lot of my negative energy still goes towards pump and dumps and means because they're structural. It can be stopped, but you can see I love in my live streams. If anybody has some post from somebody they want some comment on or opinion on, let me know, because this is what I absolutely love to do sometimes on these live streams. But today I'm doing something a little bit different. Another, you know, smaller channel. I think Sam McColgan here has around 4,000 subscribers, around the same as I do. This is Sam from Breakout Investors Ahead of the Curb. And this is Sam's Twitter/X account. Absolutely, when I'm done this video, I will post to his profile down below in the pinned comment. Go check Sam out. And the reason that Sam is my focus today is that he wrote this article here recently, December 3rd, and this is The Right to Win, a framework for asymmetric returns in microcap markets, an outline of my investing philosophy. And it's a very good article. I want to talk about it here today. And the reason I want to talk about it here today is because, number one, it is a boring time of the year, right? There's not a lot of news. There's not a lot of stocks to talk about. So the two things that I typically recommend people do is, number one, research, research, and research. I recently on social media argued with a post that basically said that, you know, most of the time investors are just sitting around doing nothing, waiting for that perfect opportunity. That is not true. The best investors are not sitting around waiting for that perfect opportunity. They are finding it, right? They are putting in tens and hundreds of hours in behind the scenes, researching, looking for that next perfect opportunity. So when things are boring, like maybe they are now, the more time you spend on research, the better. Although I would say, I don't know why I make this number two, because I think it's probably the number one, if you had to actually rank it, was working on your strategy. And again, this is the perfect time, this time of year, to go back and look at what went well in 2025, what went wrong in 2025, what you can do better in 2025. What's the plan for 2026? And I feel like Sam's article here is absolutely going to, you know, be a good reminder for experienced microcap investors and be a good start for some of the newer microcap investors. So beyond this point, I am going to mention a few stocks, not a solicitation to buy, sell, or hold any of these stocks. These are just my opinions. If I seem negative on a stock, that doesn't mean anything. Most of the stocks I'm going to be talking about are just used as examples to help explain Sam's article a little bit. So absolutely not financial advice. But when I get into this article here, this is the introduction, and I start finding things that I agree on right away, right? Where Sam says the existential necessity of the right to win is what he calls it. And I'm not going to read this whole thing, but basically this is the introduction for Sam, is that in the modern financial ecosystem, the individual stock picker faces an existential crisis. Most market participants engage in a game they are statistically destined to lose, competing in arenas where their informational and analytical capabilities are vastly inferior to those of their counterparts. And I completely agree with this statement. This is why I do not invest in like large cap stocks, mega cap stocks. I simply can't compete against institutions. That is one of the huge reasons for being down in the microcap space, is you're not competing against these other institutions, these people with unlimited resources, unlimited capital, just about anyway, compared to like your average retail investor. but it reduces your competition. And I absolutely agree with this, is that you're kind of statistically destined to lose in those types of markets. He then moves into saying that the concept of having a right to win posits that alpha is not a product of luck or generic effort. Rather, it is the result of deliberately and solely playing on a battlefield where the structural dynamics favor an investor's specific attributes and strategy. I completely agree with this. I don't think I did it publicly, but I had a private live stream recently that didn't do me any favors, because it was basically talking about maybe microcap stocks aren't for you. Right? What is your battlefield? Where is the best place to put your money? Where is the most skills that you have? Some people are very good at real estate, right? I'm terrible at it, right? Some people are very good at opening like a small business, or maybe you can invest in yourself and go to school, and somehow that's going to be your catalyst for making more money. Maybe microcap stocks isn't the best place for your money. You really have to pick your battlefield. So I definitely agree with Sam on this statement. Now, what Sam decides here ultimately is the same thing that I decide for myself, which is where my skills are and where my battlefield is. The most readily accessible in the inefficiencies is the microcap markets, which is where Sam is saying that he puts his money. This is the best place for him, his battlefield, to be able to make money. Choosing to do so in the stock market, I completely agree with that. That's obviously why I'm here making YouTube live streams every week, right? So then we get into the 5M strategic framework, filters for asymmetry. I can't talk right today. I'm trying. It's a lot of reading on a live YouTube, right? But this is where Sam is getting into what he's talking about. The microcap market is inefficient. That is an opportunity, but can also be dangerous. And he talks about his framework for investing that I am going to talk about here. Is the monopoly, management, momentum, margin of safety, and material upside. This is what Sam uses to invest, and I think it's worth going through as a bit of investing strategy and some basics here in 2026. So looking at what Sam is talking about here in a monopoly, looking for a big fish in a small growing pond. And I have to give him credit here, is that Sam is basically picking right off the start one of the hardest things to find in microcap stocks. While it's true global monopolies are rare, the right to win in microcaps is often found in companies with a local monopoly or best-in-class status within a specific niche. A microcap company does not need to dominate the global economy. It only needs to dominate its specific addressable market. I seek companies that provide a product or service critical to their customers with few direct substitutes. This monopoly or market dominance should be robust and sustainable. Ideally, if a microcap has a technological edge or high switching costs in a small but growing pond, large competitors often find the niche too small to bother attacking. This leaves the local monopoly to compound earnings undisturbed, and that is exactly what you want in microcap stocks. Hard to find. I talk about this quite a bit. And where do I talk about this quite a bit? Not quite as eloquently as Sam, but I basically say that a lot of the times when I'm looking for stocks, I'm not just running a stock screener and looking for random stocks. I find an industry sector that I'm bullish in, and then find the best stock within that industry sector, right? So I'm looking for that small but growing pond. Kraken Robotics, underwater robotics. Everybody was looking at aerial drones. This was during the start of the Russia-Ukraine war, right? I found underwater robotics, saw the opportunities there. Underwater batteries, that obviously has worked out incredibly well, but Kraken Robotics is a great example of this. NextGel hasn't had the same success yet. I know people are sick and tired of me talking about NextGel, but they basically have a moat in their hydrogel products. Does that make it a lock or a guarantee or the best company in the world? Absolutely not. But they're definitely a big fish in a small growing pond of hydrogel products and companies that can use this, right? So that's one of the reasons why I like NextGel. D-Box Technologies. And this is sometimes why I'm not too worried about companies like NextGel, because you could see all these years of stagnation here for D-Box. Now, in their fairness, this is, a company that's related to movie theaters, which got absolutely destroyed in COVID. So you can't really blame them for all of these years of stagnation. But this is a company where they sell, what is it called? Actuators. Basically moving devices to move seats for those D-Box movie theater seats, the premium movie theater seats that you pay for. They basically are another, big fish in a small but growing pond as they grow their theater market share basically across the world. This D-Box right now is a fantastic example of what Sam is talking about here, in my opinion. Another example, potentially, maybe a bit more questionable, was Gatekeeper Systems. I was looking at the industry niche, looking around, looking at the crime statistics, how much crime there was coming up after COVID, and thinking that, more public transportation companies needed security devices, security cameras on buses, on trains. That was Gatekeeper System. Now, you could argue they have quite a bit of competition, so I'm not sure if I throw them in the same boat, but they were the only publicly traded stock that had this technology, so sometimes beggars can't be choosers, right? So Gatekeeper Systems, potentially a good argument here. Couple stocks that I like, though, doesn't always fit my rule, right? Zoom Technologies, I don't really know that Zoomed is arguably a small growing pond for ad tech. I don't think that really applies, right? Do they have any kind of moat or a moat and lacking competition? Not really. I think Zoomed would say yes, but I don't think they do. And then same with AudioEye. I really like AudioEye, but a lot of competition. So sometimes you kind of deviate a little bit from what Sam is saying here, but overall, I would suggest this is a fantastic start to Sam's strategy for microcap investing. Moving on to the second part of the 5-part series here is management. Look for stewards of capital. In the microcap space, the management team is the company. Unlike a megacap where the culture can survive a mediocre CEO, a microcap is intimately tied to the quality of its leaders. I look for shareholder alignment and customer centricity. To make good decisions for shareholders, management teams need both good intentions and good capital allocation skills. To access intentions, look for higher insider ownership, often accompanied by owner-operator structure, or at least team-level incentive structures. To get a sense of skill, I probe the team on what they plan to do with cash. If M&A, what kind of M&A, how to fund it, if buybacks, at what price. Beyond alignment, I look for a relentless Amazon or Costco-like obsession with the customer. Too heavy a focus on the stock price is typically a red flag. So when you look at this again, I have to agree with Sam here. You're looking at cash. I think that was a big learning, especially for certain companies in 2025. Simply solventless concentrates, hash, share price crashed. What did it come down to? The cash. We weren't paying enough attention to the cash. They necessarily weren't the best stewards of capital. High share dilution, low cash production. Ultimately, that caught up to share price. We look at some of these companies, some other examples here. Now, being a bit harsh, because I don't mind Sabio Holdings. I actually own this stock, right? But again, I got this Cantech letter from January 5th talking about covering sectors that have turned more constructive on cannabis stocks. This is another article sponsored by Sabio. So they spend a lot of money basically trying to attract attention to their share price. Right here, this is one of the main warnings that Sam basically lands on. Too heavy a focus on the stock price is typically a red flag. You want companies that are focused on customers and clients, and right now that isn't Sabio. Looking at Symmetrix, it's kind of a similar thing. I think Symmetrix spends about $150,000 a year on 2 investor relations companies. So that's a lot of money for investor relations when, share price has been volatile to down depending on where you bought it. So maybe their focus should be somewhere else. Recently, I've talked about Emerge. This is a CEO that's very concerned about share price, essentially from what I've seen. Now, in all fairness to the CEO, that has worked recently. It is up. It is now benched up again. So good work to Emerge Commerce. But long term, we'll see how this goes. This is a new dynamic of CEO that very much cares about share price, or cares about the shareholders, but cares about the shareholders through share price. We'll see how that goes. You contrast that with a company. I mean, have we ever seen the CEO, Paul Andreola of NameSilo, this past year talk about share price or pitch their share price anywhere? Basically, Paul has only done interviews or advertised even the company or the stock when people have asked him to. So this is a much more humble approach where you let the numbers do the talking and the press releases do the talking for the company. And that has worked out significantly recently for NameSilo. So as far as the second point here from Sam, I think it's another great point, right? Looking at the cash, looking at the management team. The third point here, momentum, look for traction in fundamentals and price. Traditional value investing often eschews momentum, viewing it as speculative. However, in the microcap space, value traps are even more pervasive. These are cheap stocks that remain cheap indefinitely, but because no catalyst emerges. Therefore, the right to win requires a mechanism to validate that the market is beginning to recognize the company's worth. Again, you'll hear me talk about this a lot. Inflection point, inflection point. If I'm considered anything, or at least some of my biggest wins in the past couple years on YouTube have been those inflection point stocks. You watch a lot of my videos and you'll see me look at these companies that were trending down. They're in some form of transition. They hit a bottom. They get 1 quarter of improvement. We're looking for that 2nd quarter of improvement to see things trending up, trending in good directions, getting that momentum. I completely agree with this paragraph. It's very important. Sam further breaks it down here where he talks about the different types of momentum as well, which is also very important. I talk about this all the time. Are you investing or are you trading? When you talk about fundamentals, the earnings, risk reward is usually better from the second inning onward, meaning not necessarily trying to time the bottom, but finding those, 1st quarter of profitability, 2nd quarter of profitability. I see companies undergoing a positive transformation, such as revenue acceleration from a new product launch or margin expansion from a business model transition. However, management teams will usually try to sell investors on the story before it is knowable whether the story will pan out or not. I look for traction and tangible progress in numbers before giving a story credence. So again, be skeptical, right? CEOs, management teams will say a lot of things. This is going great. We have this transition. I love this, right? This is what I just said. There's always this transition, this business model transition. The company will say it's going absolutely great. If you look for that greatness in the numbers, if you can find that company that says it's going great and it actually is in the earnings, in the fundamentals of the company, it is going great, that is absolutely what we're looking for in fundamental momentum. You see that, talking about the 2nd inning here with fundamental momentum, it's interesting because we have some companies that struggle to get it. Much more popular company coming up right now, CanPR Technologies, recently pumped up here. It's had 1 quarter of very strong profitability, which improved its share price here from going straight down to popping up and getting that bench. But you see the confusion and the volatility since that time as people are waiting for that 2nd inning, that 2nd quarter to pop up and show some consistency. So when a company does not get this, you get this type of volatility, and hopefully if CanPR Technologies can get that 2nd quarter of profitability, you're going to see a more strong, more consistent share price in good directions, right? When you're talking about price momentum, that's what you don't see a lot of the times on my live streams, because I show you a lot of charts like this because they're very easy for YouTube. You see the 1 year percentage, it's a nice simple red line. You see the months down here. It's not a lot to take in. But mostly what I'm looking for when I'm looking at price momentum, most of the day I'm looking at charts that are a little bit closer to that, right? You see this type of momentum up, you see this type of sustained momentum down, and that's the type of trading technical analysis that you're looking for with price momentum. So typically what I do, and I love this post here from Sam, is that I research and I find stocks using fundamental momentum, and then I decide on buying opportunities or selling opportunities with this technical momentum. So right here, this is what Sam is talking about with price momentum. I see the stock market as the interplay between a storyteller, the company and its fundamentals, and the audience, the market. And I love this statement because I say this all the time. Story stocks back in COVID were kind of the meme stocks. Those stocks that had huge potential and no actual meat and potatoes to them, right? They told a story that never really happened. And I feel like that gave a lot of microcap stocks a bad name. When you say a story stock these days, it's a negative connotation. But for me, typically if somebody pitches me a stock, I want you to tell me a story, right? There's always a story here. Why would I invest in this company, this stock, over all the thousands of other options out there, right? These companies need to tell stories. If you're pitching a stock, I know a lot of people try to pitch stocks to like Microcap Club or some other places where they want to convince other investors to buy their stock. Make sure you tell a story, right? It's so important here, and I absolutely love the statement. You have to explain the why. Now, the basics, the fundamental momentum, the technical price momentum, again, book here up on the wall. I should really have a link so I make money. I like plug this book just about every live stream, but for newer investors, How to Make Money in Stocks by William J. O'Neill. This is basically the can slim approach. And this concept of fundamental and price momentum basically comes right out of the can slim approach for microcap investing. And this is why I'm agreeing so much with Sam on this post. I think he sees the same thing. One of my primary methods of investing in microcap stocks is using like a modified can slim approach. And then over time, as I do more research and build more conviction in a stock, that's maybe when I might hold it longer, and I end up holding it for 5 years, 10 years, whatever it is. It turns into more of like a coffee can stock where I've owned it for a decade. But most of my stocks, especially at the beginning, really start out as like a can slim type trade here. So finally, the fourth thing, margin of safety, the physics of downside protection. Now, this is interesting talking about this in 2025, because if you remember 2025, June, July, everybody was a genius. Stocks were up 100%. And then by November, December, everybody's in tears because stocks are down 50% and you've lost your 100% gains, right? So you have to be aware of this downside protection. I like that Sam has it right in here. While my definition might differ from Graham's, I also look for opportunities with a margin of safety, which I define as investments which are a coin toss between heads I win, tails I don't lose much. I agree with this, and you can go read this. This is a bit complicated. That's my only argument. One of the issues with these types of investing strategies or investing styles is that Sam here talks about modeling. So he does pre-mortem analysis before investing. I assume the investment has failed 2 years from now and asks what happened. I then model the valuation in that failed scenario. My only criticism here of Sam is that's because he has the time to do this. Most small retail investors don't necessarily have the time to sit down and run forward models and run backward models and run all the models. If something fails, if something doesn't fail, it's tough for people to find the time. So my only argument here, not argument, but I think another option is to be careful and consider stop losses. I talk about stop losses all the time. I don't use automatic stop losses. That's crazy. But if you just pay attention to a stock, right? And if you're willing to say, look, it's up 50%. If it goes down 20%, then probably there's something wrong. My strategy's wrong. The company has changed. If it goes down 15, 20%, I'm just going to sell, right? Some amount of stop loss will limit your downside risk and protect your capital without having to put in all of this time with pre-mortem analysis and modeling all these failed situations. It is the best thing for Sam to do, but I'm not sure everybody has time. Again, picking on a company like NTG Clarity Networks, but you know, you take a stock like this, it ran up here. If you had stop lossed here, you made a lot of money. If you bought back and then it ran up again here and then you stop lossed here, you made a lot of money. It ran up again, maybe you missed that, but you bought anywhere here, and you recognize that this did not work and you stop lossed and got out, during all these trades, you still made a lot of money. So that is one of the superpowers of small retail investors, is having that ability to buy quickly, but also having that ability to sell quickly. I think it's underutilized here. And then finally from Sam, the fifth and final part of his investing strategy, material upside, the asymmetric payoff. While the previous filters mitigate known downsides, the greatest threat remains the unknown. Paradoxically, one of the best defenses against unforeseen risk is aggressive upside. I reject bunt singles, 10 to 20% returns. They cannot compensate for the structural opacity of microcaps. Instead, I require a plausible path to a 2x valuation within 12 months. This usually demands a Lollapalooza effect, rising revenues, operating leverage, and expanding multiple. If a thesis lacks this asymmetric potential, the reward is insufficient to compensate for unforeseen risks. Very interesting, very aggressive, I will say here, absolutely, but I understand it. And again, it's that momentum. It's looking for these companies with fundamental momentum, pricing momentum, potentially could 2x in 12 months. My only difference here for me, I do something very similar, but I'm probably a little bit less aggressive, and I should talk about this a little bit more for myself. I'm looking for 2x in 2 years personally. I do not mind, like if I'm looking at a company and I think it's going to give me 50% returns in 1 year and not 100% returns in 1 year, generally, as long as that downside risk is minimized through either research or stop loss, I mean, 50% returns in a year, I would absolutely not argue that, right? The other thing with some of these 10 to 20% return stocks, I do sometimes do what I call like foundational investing, where I don't want every stock in my portfolio to be this crazy high upside, which usually means significant amount of risk. Right? I am willing to put a few stocks in my portfolio that I consider more foundational stocks that might only give me, 20% returns in a year, but they're kind of guaranteed to do so with very, very, very limited downside risk, right? I am willing to start with a few of those stocks. And then really, again, not enough time to talk about it today, but in all this, with all this discussion about what stocks you want to buy, for me, it does come down to position sizing, right? Like you can limit risk by having smaller position sizes. And as your position size increase, you increase the risk. So for me, again, that kind of comes down to this slide here, which is why I essentially made this book go smaller over time. Is if you invest big, you have higher risk right there. So something to consider, but I definitely agree with Sam here. Investing, I compare it to poker all the time. Always a mix. And I think in layman's terms, what Sam is trying to say here is just make sure, like too many investors, especially new investors, eyes on the prize all the time, only looking at the reward, not paying enough significant attention to the risk. I completely agree with that. And there's different ways to mitigate that risk, right? Run your models. What happens if this stock fails? What are you going to do? Are you looking at the technical analysis? Is that how you're going to make your decision? Or are you modeling out what a potential failure looks like? What red flags are you looking for in a potential failure? You always have to be looking for these types of risks and then balance it up across these rewards. Now, I might not look for a 2x stock in 12 months. I might look for a 2x stock in 24 months, but I think myself and Sam's investing strategies are quite similar. I'm very impressed. Probably one of the best articles I've read this year. Right? No, it's a seriously good article. I know it's only January 5th, so it's a bad joke. Lots of reading. I only covered maybe a third of this article from Sam. He talks about how to find and do due diligence these ideas. So more reading in this article from him. I will put the article, I wonder if I actually have it copied right now I do. So I'm putting it in the chat right now. And when I'm done recording this video, at the bottom of the video, in the pinned comment, I will also have a link to Sam's article here. At the end, he talks about the structural advantages, defining the battleground, all kinds of wonderful decisions or decisions, strategies, and opinions from Sam. Absolutely love it. Now, the hard part here, what he's talking about is, making it sound maybe a little bit easy, right? Talking about applying the framework with consistency. I aim to build a portfolio where the odds are deliberately tilted, limited downside when wrong, and meaningful compounding when right. I absolutely agree with that. One of the issues, though, I think people forget sometimes is you have to do that fairly often in microcap stocks. Man, things change quickly, as you've seen from the first half of 2025 to the second half of 2025. It was the tale of two different companies, two different markets for microcap stocks. So this is a fantastic strategy, a fantastic framework for new investors to learn. What are you looking for in microcap investing? This was a nice short little book I absolutely loved. But you have to remember, you have to find the time to do this kind of over and over and over again. Evaluate your thesis at least every 3 months on earnings, and make sure that those M's that Sam was talking about are still being met by the company. As always, presentation over. I'm going to go check out the comments now. So questions, comments, stocks you want to talk about, now is your chance. If you're just cutting out here, thank you for watching. Really appreciate it. Don't forget to give me a like before you leave if you don't mind. And then finally, I've talked about Ian Castle and small cap discoveries and breakout investors. My own plug here, if you want to, this is the first time watching me at Common Sense Investing, head on down to commonsenseinvesting.ca, and I talk about basically what I do in my different platforms here on Patreon, Substack, and YouTube, and everything else, so you could learn a little bit more about me. But that's it. I'm done. What do you have for me? There's a few comments here. I can't believe that I could find time or a topic to speak for. When I started the day, Monday, first day of trading, on the first week of trading in January 2026, I thought to myself, what in the world am I going to talk about, Cameron? There's nothing to talk about. And then I always find something to talk about. It's kind of scary sometimes how that happens for me. My wife would actually complain sometimes that I don't talk enough. So it's weird that I come on a live stream and just talk straight for 35 minutes. I'm looking forward to seeing how grid does this year and the theme of power grids. That's fair. I don't cover grid a lot simply because what Sam just talked about in that article, and I'm just pulling up the charts for you. Grid is Tantalus Systems Holdings, because what Sam talked about in the little presentation that I just gave you is basically having an advantage over institutional investors. And one of the problems with a company like Grid that I don't really like is that it has institutional investment. Now, it doesn't have a ton of institutional investment, but when I go down here, and I don't know how accurate this would be on Yahoo Finance, I'm seeing 19.83% institutional investment in Tantalus Systems Holdings. So it's not a lot of institutional investment. It's not 40, 50, 60% like some other larger companies, but it's still more than zero. At the same time, I mean, you look at price momentum, hard to argue against that chart. That's a company that's been doing very well. I wish, looking back in hindsight, I talked about them more than I did, obviously, right? So good, congratulations. If you've been a holder of that stock all this time, it's done very well, and I can see why you're excited looking forward into the future of this company. This is an incredibly valuable article. Read it earlier. Yeah, I agree. Thank you. I breezed through it a while ago, and I didn't really start reading it until I needed a topic for today's live stream. And I started really digging in, thinking I might pull a couple clips from it and talk about the clips in this live stream. And once I started digging into that article, I was like, holy shit, I can't pull a couple clips. I need to pull like 5 big chunks, basically his entire strategy out. Let's talk about it. Why not? What else are we going to talk about today other than, investing strategy? And when you look back at 2025, and again, I say it so much, I'm just going to pull up another chart here, right? But again, it comes down to me sometimes investing in microcap stocks. It's not necessarily about stock picking. I hate to tell you sometimes, like, you didn't need to necessarily discover, this is Zoom Technologies. You didn't necessarily need to discover Zoom Technologies down here to make money. You can let other people discover Zoom Technologies, tell you about Zoom Technologies, and you could have bought in here. And if you did that, where you did zero research and just looked at Substacks and, you know, people you trust on social media that says, hey, take a look at Zoom, this could be a good stock, right? You do your own research, you buy that stock right around here, you would have made a shit pile of money right up until end of October, basically Halloween, right? You would have had significant returns in Zoomed until you didn't. And you just see that share price absolutely crash. Maybe that was the one thing that Sam didn't talk about in that article, just briefly, right? It's okay to have downside protection, but what do you do on a technical standpoint when, you know, I just talked about stop loss. It is a whole nother investing strategy to get that concept of when to sell, giving up, right? People, oh, you're giving up. This is still a great company. But you look at it here, this is one stock, one simple stock, one microcap stock on the market. And depending on when you bought and when you sold, you either made a shit pile of money, you lost a shit pile of money, or if you bought here and you're still holding, you just broke even, right? So one stock, 3 different investors, 3 massively different gains for the year in 2025, just based on your investing strategy. So please, if you're a newer microcap investor, do not go out looking for the most genius stock picker in the world. You just need sometimes some okay stocks, some okay companies, and really good strategies. Haptics. What did I say? Actuators? Yeah. It's Monday. I can't say thanks, Brem. Really appreciate it. Haptics. That's for D-Box Technologies. That's what they produce. That they have. I don't know if it's necessarily a moat. I know it's considered a moat in Canada. I don't know if internationally it is or not, but something to look into. What's my opinion on Auxly for 2026? So that's an interesting thing here. So if I bring up, and I wasn't going to mention them here, but I kind of had to, is that if I go back to this presentation, Auxly is a cannabis company, one of many Canadian cannabis companies. When you look at what, you know, Sam is requiring here for his strategy, big fish in a small growing pond, arguable, right? Can you call Canadian cannabis, a small growing pond? Maybe. Are they a big fish? Maybe for microcap stocks. As far as profitable big fish, I would suggest, okay, maybe Auxly fits, you know, the first part of Sam's strategy here. Stewards of capital, again, big question mark for me, right? Auxly was nearly bankrupt at the start of 2025, and they found a way to get out of it, and now their balance sheet is improving. So this is always a tough one. Do you give them, you know, negative points due to the near bankruptcy less than 12 months ago? Or do you say, holy shit, what incredible stewards of capital, because they got through that bankruptcy, they're coming out the other side and they're improving. So part 1 was kind of a question mark for me. Part 2 is kind of a question mark for me. Fundamentals and price, yeah, arguably, right? Balance sheet improving, getting some growth. I would suggest in any way, shape, or form, if you're looking at the strength of Auxly, I think fundamentals, being careful though that it's not a value trap. I mean, Sam talks about this here. And until maybe the cannabis narrative changes, until people are bullish on cannabis stocks again, are some of these cannabis stocks a value trap? So again, based on Sam's strategy, I would suggest Auxly is a bit of a question mark here. Price momentum, I'll show you the chart in a minute, but it was good in 2025, but it's been struggling recently. Margin of safety, Again, close to bankruptcy recently, still a lot of debt on the balance sheet, still owing a lot of money. They're significantly improved. I think they removed their going concern warning from the recent earnings. So they definitely have some downside protection. They do have some actual assets, but again, it's not super strong as to point 4 of Sam's strategy here. We go to part 5, which is the asymmetric payoff, and that really brings the question mark of where do you think the share price of Auxly can go, right? So I'll bring up the chart here, and now this isn't necessarily my opinion. I'm just kind of showing you what Sam's strategy is compared to the reality here of Auxly. This is one of my favorite cannabis companies. I own shares of Auxly. You can see it had price momentum right up until July, and then it's just been consolidating ever since. So the question is, on a risk reward basis, where do you think the risk is? Do you think there's any chance if it fails that it benches back down here to 8 cents, which would be a 50% drop? Where do you think share price can go? It's $202 million market cap. That's fairly large considering what they do, but at the same time, one of the few small profitable cannabis stocks, but large for a microcap. It's going to get noticed by institutions. Can they succeed? Where do you think the upside risk is? So lots of the times when I say, when you're looking at a stock and using Sam's model, you do have to factor that in, right? Where's the downside risk? Right now it's at 15 cents. So then I say, okay, look, I think I've done my modeling, and I think the downside risk here is it goes to 8 cents. So worst case scenario, I lose about 50% here. I'm going to say that if anything bad happens, I'm going to try to stop loss out of here at 12, maybe. So somewhere my margin of safety is somewhat Safeway. My margin of Safeway is probably, hopefully, somewhere between, if I'm buying at 15, somewhere between 8 and 12 cents. I see the potential upside as what? Where do I see Auxly going? You know, Sam is looking for 2x in 1 year. Do I think that Auxly hits 30 cents in 12 months? Not bloody likely. A lot of things would need to change in cannabis. All of a sudden, people would have to get massively bullish in cannabis stocks. But could I see them going to 30 cents in maybe 2 years? Yeah, potentially, right? I don't know what your thoughts are, right? So you have to look at it here from a sustained 20,000 feet from the sky, right? If you buy today at 15 cents, what is your downside, safety risk here? Are you going to stop out of this, or are you just going to hold to the bottom and try buying more? What do you think the potential upside is? You have to look at the potential reward right here versus the potential risk, and then make your decision. And for me, like I said, that really comes down to position sizing and what other stocks I have available to me. Maybe I have some stocks that have higher potential but higher risk, right? How many of those high risk stocks do I want in my portfolio? Maybe I think that Auxly is lower risk because I think I can stop out at 12 cents if anything goes wrong with this stock. So maybe it's one of those bunt plays, like Sam calls them, where I'm only making 20% per year, but the downside risk is low. Do I want to own that stock, right? There's so many questions that need to go on here when Sam talks about modeling. But that's kind of where I'm thinking with Auxly. I hope, I'm not saying it will, it's not financial advice, but 30 cents in 2 years, potential is there. Stop loss out at 10, 11, 12 cents if something goes wrong. Okay. Can I live with that? Yes. Are there better stocks out there? That's a big question for me, is opportunity cost, right? If you're investing in any stock, not just Auxly, but if you're investing in any stock, is that the best stock out there? Is that the best stock for you? Is that where your specialty is? Do you frickin' use their products twice a day, right? I don't know, right? You got a lot of questions to ask there. So that wasn't necessarily opinion. That was kind of maybe Sam's opinion or a comparison to what Sam's strategy is. But I think that gives you an idea of some of my thoughts on that. What impacts do you think about McCoy Global with Venezuela case? Nothing. So we've had a lot of discussions about Venezuela. I don't see anything happening in the short term for any microcap stocks especially, right? I know today with Venezuela, gold and silver went up, price of oil went up. Large Canadian oil stocks went down because potentially Venezuela could be competition for Canadian oil producers. U.S. oil producers went up today because in theory they could be producing low-cost Venezuelan oil in the future. I think the experts that we've seen on social media say that this is probably, people are getting way ahead of themselves, right? There's no established real stable government yet. There's no execution of this, a stable government for any length of time. It isn't even established yet. We don't know what's going to happen next week, never mind the next 2 or 3 years. And it's going to take 2 or 3 years to rehab their massively destroyed oil industry. The infrastructure, everything has challenges. What are they going to do with that oil that was going to China or Russia? Oh, it's just a mess. So right now, I don't think there is any impact. Can you sit here and can you on social media pump up McCoy Global by saying, oh yeah, they're going to, once Venezuela gets going, McCoy Global is going to be selling $100 million of their smart TAR systems to Venezuela? Yeah, someday, maybe 2, 3, 4, 5 years from now, maybe. But really a best case scenario, in my opinion, not something that I would factor into my buying or selling of McCoy Global shares, that's for sure. If there is a screener that screened for all of the principles that Sam follows and that you summarized tonight, what are some stocks that come to mind that screener might spit out? So that's, look, I'll tell you what, on that presentation, you don't have to do that. So I'll show you right now what that screener would look like, because if you go to my presentation, right at the top is Sam's X profile right there, right? If I pull up X here for you, I will go to Sam. Just give me 1 second. And basically, if this is his investing pitch, then he's already got screened out some of what he thinks are the best stocks as per what his screener would pull out based on his investing style. And your list is in the pinned comment right on his X profile right here. So you've seen that I've actually covered, and I actually like some of these stocks. Crescendo, this CREX I've covered before, CXDO I've covered before. We both agree right here on NextGel. We both like that one. Some of these I've never heard of before. I haven't had time to go through all these stocks. But if you go to his social media profile, for the screener for Sam McColgan's investing strategy, I would suggest they're all right here. And then anything new or anything's changed is going to be just down this down his social media profile right there. So that would be my best answer for you, is head to X and look up Sam McColgan, and he'll probably tell you what's on his screener. So for me, it's knowing if your thesis revolves invested, long, or trading. Saves a lot of headaches. 1000%. Yeah, I wish I had up the slide. I thought I did have the slide. I don't know why it didn't show up, but I always have a slide that says investing or trading. I pulled up my risk versus reward slide, and I did not pull up my investing versus trading slide. But again, I guess I could go to this slide here, which I touch on quite a bit. If I go to this is basically me saying that almost every stock that I buy at the start, my first purchase on a stock, I'm almost always a trader. Right? Like I've been researching a stock for maybe 10 hours, a month, couple weeks, whatever it is. I bought D-Box Technologies after 3 days. I did three days of research and bought D-Box Technologies. When you're buying that quickly, you have to be willing to sell that quickly. So for me, when I'm actually starting a position in a stock, 99.9% of the time, I'm actually a trader. And then again, over time, as I do research and as I gain confidence and as I build conviction, then over time, I turn into kind of a long-term investor. So I even try to avoid that stress, that mental stress of when I'm investing. Am I trading? Am I not trading? Am I going long term? How long term? I try to stay away from that. I avoid that entirely. And again, for me, I try to avoid that entirely by just building a thesis and then evaluating that thesis basically every earnings, every 3 months, and or on any major news. So basically every 3 months, I'm deciding whether or not I'm going to buy more of the stock, trim, hold, or sell. I should have hold in there, but basically that's my strategy, and it reduces my stress because I don't have to sit here every day and think to myself, well, am I trading? Am I a long-term investor? I'm a long-term investor, but it's going down. I'm losing money. What do I do? Like, I always talk about having a plan. So yes, I completely agree with this, right? How do you assess a potential 2x stock? What are your signals? Well, I think a lot of my signals are what I was looking for. One of the things, another good person to follow on social media is Ryan Telford. And one of the things that Ryan Telford has changed my mind on recently is it's not so much about static numbers. It's about trends, trending up. And I've been talking about this now for 2 years. Ryan Telford put this on me about 2 years ago. If you take like a company with absolutely terrible margins, 1% margins, but they can increase those margins to 2%. That's a 100% increase in margins, right? That's huge. Versus, a lot of these newer investors might be looking for the stock with 80% margins, but they really are on the upper limits of what they can do, and they have nowhere to go but down. So the next year you get 70% margins and then 60% margins, and every year you're getting declining margins, right? And so you have this high margin stock that's going down in share price. You don't understand why. You have this low margin, bad looking company over here that's going up in share price. You don't understand why. So for me, when I'm assessing the potential of a 2x stock, I'm looking for trends is what I'm looking for. And then I'll look at the valuation and say reasonably where it can go, of course. So I look at the fundamentals, I look at the valuation, and then I look for that catalyst on what can change those two things. I will say though, is that when I say 2x, I know a lot of people run crazy models, and if you have the time, do it again. But my channel is typically more for the average retail investor. You've got a full-time job. You're not sitting here 7, 8, 9 hours a day running models on stocks, right? You maybe have 2 to 3 hours a week. You need to be careful of your time. And so I would suggest being careful with some of your models. Like if I look at a stock and I reasonably say, look, it's at, 10x earnings, and their margins are trending up and they're growing at 30%. Is it going to 2x, or is it going to 1.5x, or is it going to 2.5x? I tend to not necessarily worry as much about that as some of these other more professional investors that always do these models that they claim are perfect. Basically, for me, again, common sense investing, keep track of your time. If I look at a stock valuation-wise with catalysts trending in good directions, I don't specifically say, well, this thing's going to go up 220% in 12 months. I don't try to make those very specific price targets, because here's the other thing is that, again, if you go back to my slide, which I'm not going to show again, but if I'm running those models, I need to change those models every 3 months on earnings, right? So that's a lot of time. So that's basically what I'm looking for. Trending up fundamentals, trending up price, good enough valuation that I could see some valuation improvement, reasonably see between those three things, revenue going up, margins going up, valuation improvement. Yeah, this could 2x. That's exactly what I'm looking for. And like a lot of people are saying, if you look at the coffee can, I'm looking for 10x stocks. I never look for 10x stocks. I find a stock that can 2x. And if it 2x's, I'm going to look at it again. Can it 2x again or not? Right? I'm not looking for 10x, but if you pick enough 2x stocks or one stock that simply 2x's 3 or 4 times, you're going to get that 10x stock, right? So that's kind of what I'm looking for. What did I talk about tonight? Yeah, investing strategy from Sam McColgan. Have I had a chance to talk to Paul Andriola? No, I have not talked to Paul in a while. I should probably do that because I am looking forward to, or potentially offering to interview him as the CEO of Name Silo, just to get a little bit more attention on that company and that stock. You looking at penny stock like that will fail. You'd have to explain that one a little bit more. What are your thoughts on Rumbu Holdings, RMB? What concerns should you have on a company like this that I should be leaning into? Well, one of the things with Rumbu is it's such a tiny company. I'll pull up the chart here for you just to talk about it. So Rumbu it's up again 22% to $1. So the management wanted to do a financing somewhere at $1 or above. And what happened is with Rumbu, oh shit, sorry, I don't have the chart up for you. There we go. Rumbu, it went down here to 75 cents or so. I actually bought shares. I'm currently a shareholder of Rumbu. Not a lot, just a small spec buy position, but just for disclosure. And it ran up here in price quite a while. So $1.35 Canadian, right? You could see this 52-week range all the way up to $1.41. The management team has basically explicit instructions, or what they want to do is do a financing probably greater than over $1 Canadian. And one of the problems is share price went up here all of September, all of October, and then half of November, so 2.5 months, and they did not do a financing. So why is that? Well, one of the problems is they were running is it even in here? They announced an acquisition or something like that. Yeah, right here. Rumbu announces the acquisition of Warren and Sons. And you notice this timeline 2 months ago. So right when share price was up and right when this company should have been doing a financing, they did not do a financing because they were busy with an acquisition. So that is one of the risks with some of these tiny stocks, is you basically have one guy doing everything. And because he was busy on this acquisition, he did not get the financing done. And at the time, especially when share price went down to 75 cents, that was a big problem. They need some cash. How are they going to grow without cash? And so now that I see share price going back up, is there a reason for this? Can it get back up to this price again where they could potentially do a financing and bring some cash into this company? But what you're seeing with these tiny companies, the biggest risk is that if they can do a financing well, and if they can bring in cash, and if they can do the next couple acquisitions, 1 or 2 acquisitions very well, and investors like it, then a company this small, $12 million market cap, will absolutely go up in share price. One of the problems is again, potential reward is very high on such a small company, but potential risk, I mean, this one just went back in May, was 26, 27 cents, or 29 cents right here, right? Not much has changed in this amount of time other than investor sentiment, right? They haven't acquired, well, they made one acquisition for $1 million, but it's not a materially huge different company. So if they fail, if they can't get this financing done, if the terms are bad, if the dilution is bad, if the shareholders don't like the financing is bad, and then the second acquisition looks bad, investors don't like it, takes too long, they overpay, anything like that, that's the downside risk in my opinion. So if I'm going to compare this at all to looking at what Sam just talked about here, I would say it's going to this 3.2 is the biggest risk and the biggest reward for a company like Rumbu. We don't know. Their management team right now, despite what people will tell you, is actually quite new to the public market. So is their financing going to be good? Is their acquisitions going to be good? If they get good execution and they are good stewards of capital, then the share price is going to go down. If they get poor execution and they are not good stewards of capital, then share price is going to go down, right? Sorry, it's going to go up, it's going to go down. It really depends on me, how they deploy their capital. And because this is such a new company, we really have very little history of this, very little history, right? We basically have one acquisition that is not the company buying its own company, right? Because the management team came into this with their own funeral home services. And so not a lot of history there. So that would be my risk, is basically management execution on Rumbu. No history of it. Are they good stewards of capital or are they not? Let's see here. Any thoughts on Pudo Inc? Recently put it onto my watch list. No, I'll take a look at it. I know it's becoming very popular right now. I know it's been mentioned by some microcap investors. I'll have to go take another look. It's not an industry sector I'm really bullish on. So Pudo Inc. does last mile delivery. Basically, if you can get a package to a town close by to you, they do the last delivery, getting it from the town to basically your house or whatever it is. I've researched companies like this in the past. It takes a lot of capital to get this going. It takes a lot of networking. Everything needs to be working perfectly, like your teamwork, your partnerships with all these different. A lot of things could go wrong with the business, and I'm not very bullish on the industry sector. So I will look into it, but right now I don't have an opinion on them. I haven't looked deep enough into them other than knowing that it's been showing up all over my social media feeds for 2026. And so people are looking at Pudo, but at this point, I don't know enough about them other than not my favorite industry sector. What are your thoughts on MCM, AV, and also PNP.to? Pine Tree, is that Pine Tree Capital? I'm an hour and 4 minutes into this live stream. I think it's too late for me to look up 3 different stocks. I'm just going to see here if I thought I recognized PNP and then see if I have. Yeah, so that's Pine Tree Capital. I can give an opinion on that one. So one of the issues I have with a company like Pine Tree Capital is if you look into that, what do they do? So this is a venture capital firm, private equity firm specializing in early, later stage, venture, middle market, mature, later stage. So it's a venture capital. And the operator of Pine Tree, I believe, is the son of, Jesus, it's too late in the day, right? Where's his name? Once I see his name, I will be, there we go, Damian Leonard, right? So is the son, it's a Leonard, very famous Constellation Software CEO, one of the greatest or the greatest acquirers of companies in recent memory is this gentleman's father. And so people are very excited that you have the son of one of the best, we just had that slide talking about, are they a good steward of capital? Basically, the Leonards are fantastic stewards of capital, or at least we hope so, right? The problem I have with a venture capital is I'm just not very bullish on venture capitals because you have to give your money to somebody else to invest. You have to trust them. You don't have time to look at all their holdings. You don't have time to look at all their decisions. They have so many different stocks that they own. They're buying stocks. They're selling stocks. They're managing a fund. They're managing a portfolio for you. You're giving them money to just manage this portfolio for you. You probably have time as a small retail investor. I can research 10 different stocks in the same amount of time it takes me to research Pine Tree Capital's holdings. So it's a time suck for me. Now, it's actually similar to Name Silo. Name Silo is somewhat of a venture capital for Paul Andriola, but I know Paul. I've been working with Paul now for years, watching small cap discoveries. I've built up enough trust with Paul Andriola that I can work through my ego, which is the big problem of it, is my ego. It's hard for my ego to give my money to somebody else to invest, right? And it's hard for me, even though it's a Leonard, and arguably could be a fantastic steward of capital, I'm giving my money to Leonard, basically saying, invest my money. I'm a lot more comfortable doing that with somebody I know and trust and has a long-term history of success like Paul Andriola than I am with Pine Tree Capital. So that's my opinions on it, is that it's hard for me to like a company like that because it is hard for my ego to give my money to somebody else to invest. That's why I'm here. I like the control. Let's be honest here, right? I pick my stocks. If I make money, it's because I made good decisions. If I lost money, it's usually because I made poor decisions. I'm fine with that. I'm fine with that accountability. I don't like giving my money to somebody else and having it go up or down and not really understand why. Is Pudo a pink sheet that doesn't come up on a chart? I don't think so. Pudo, is it Canadian Securities Exchanges or is it on the Venture Exchange? Pudo. Yeah, I don't know where it is. Yeah, it's CSE. It's a CSE company right there. So that's the Canadian Securities Exchange. That's another reason why I'm not really interested. This is the worst, most garbage exchange possibly in the world. Okay, there's probably worst exchanges, but as a Canadian, not my favorite. The Canadian Securities Exchange has pretty lax regulations on the rules that a company can, get away with in their financials. Again, Name Silo URL is a company that I really like that is on the Canadian Securities Exchange. But again, that's got a CEO, Paul Andriola, that I trust. And so, I'm more comfortable with investing in a company that I trust with a CEO that I trust on the Canadian Securities Exchange than a company I don't know anything about on the Canadian Securities Exchange. It's just not a high quality exchange. It just really isn't. So, so many times I've invested on a stock on the Canadian Securities Exchange and just got burned. So that's another risk you have to look at right now. What's my longest holding microcap right now? Well, it's not a microcap anymore. It's definitely not a microcap anymore. So I would have to look. There's 3 or 4 stocks that are in the running for that. So one of the things that it's hard for me to tell you about is I have different accounts, right? So if a company isn't a microcap stock, my microcap portfolio is actively managed. So if a company is not a microcap stock anymore and I don't want to look at it every day and I only want to look at it once a year, I'll move it to a different account and I don't look at it. So I couldn't tell you because most of my successful microcap stocks, if I'm still holding them, are in a separate account where I only look at it basically once a year. I think Michael Anthony may have supported Oxley's sales a little bit too much tonight. Yeah, I didn't see that. So I'm not sure what you're talking about. Pesorama has had a really good stretch. Yeah, it's was really surprised by it. Yeah, absolutely. I think everybody's really surprised by it. Wolf of Oakville, who I don't talk about much, but he recently covered Pesorama. I did not cover Pesorama because I took a quick look at them and decided that was not the company for me. That's their 5-year chart. They basically got destroyed. Wolf of Oakville basically had an article. I wonder if I could pull it up quickly here. And he basically says, is it up here? Yeah, Pesorama, 1 out of 5 stars for Pesorama. And at the bottom, I love what he said here at the bottom. This was a free article. Overall, do I really need to continue at this point? This is an abject disaster. And I completely agree with Wolf of Oakville. But it's interesting because, again, sometimes price action doesn't always match fundamental. So this is it. We all have that buddy who comes into a poker game, has never played poker before, doesn't know what he's doing, goes all in on a 7-2 offsuit, right? And wins and walks away with the table and all the money and thinking he's a poker genius, right? Every once in a while, you can win with, a 7-2 offsuit. You can win with a 7-8 and catch a straight in a game of poker, right? You could play that, whatever it is, 2-10 and win. You'll get those hands that'll just luckily win. The question is being able to do this repeatedly, right? That's playing your pocket, that's playing the double aces, that's playing the ace king, that's playing the high percentage hands. And the way to find those high percentage hands in microcap stocks is to do more of a fundamental analysis, looking at the valuation, looking at their revenue, looking at the quality of their revenue, their income, basically, how much cash they're producing, who owns the shares, what is the story. Like, you're looking at all that fundamental stuff, and that tells you the story. Again, talking about a story, that tells you the story of what type of company you're buying and where you think it can go. But when you're doing that, I mean, there's times where this poker player goes into a hand with pocket aces and they lose, and they'll lose to that 7-2 offsuit. It happens, right? So sometimes you get these low quality, low potential stocks that just absolutely crush it. And other times you get these high quality, high potential stocks that just for some reason never find that catalyst and just don't do very well. But at the end of the day, you're going to catch me playing more pocket aces than any other hand out there, right? It's more consistently when you do this over and over and over. It's not winning every once in a while on one lucky hand. It's about you winning consistently on more predictable hands, right? And using that type of investing strategy like used by Sam McColgan here. So That's it. No more questions, no more comments. I made it through them all. 1 hour and 13 minutes. First day, first week in microcap investing in 2026. I'm pumped. Tax loss selling is over, seeing a little bit of strength. Hopefully next week I can say that the first week of 2026 is good and we can move on from here. Hopefully get another early bull market like we did last year. That would be nice. But at the end of the day, I'm done talking. I'm losing my voice. As always, I appreciate everybody here. You could be anywhere watching anything, and we're sitting here talking about microcap stocks. You're about as crazy as I am. So I really appreciate it. I appreciate your time. Thank you so much, and we'll